Right, so retail investors rejoicing at the split of Apple and Tesla shares, both surging to new records, adding to already hefty gains so far in 2020. One shareholder who has enjoyed that run-up is Ross Gerber, president, CEO, and co-founder of Gerber Kawasaki. He joins us on the line from Santa Monica, California. Ross, great to have you on again. So really, we have seen these massive gains, and you've been a long-term holder of both Apple and Tesla. Have you taken some profits?
Well, it's been quite a fortunate time for me, as they're my two biggest holdings, too. So I've had to take profits because when you get these kind of gifts, you know, when you've been doing it as long as I've been doing, you got to take some money off the table here. The valuations are incredibly stretched, and we're certainly working with asset bubbles right now. And you know, we think the bubble will last, but we're also prudent investors. So long term, we're huge believers in Tesla and Apple, more so Tesla, and we have no intention of selling our position, but we've had to take some profits here.
Yeah, Tesla, in fact, gaining more than 50% since they actually made the announcement of this split, right? And they are likely going to get included in the S&P 500 stock index this fall. How's that going to impact Tesla?
Well, that's a huge thing, both obviously psychologically, just being a part of the S&P is an honor, and certainly one that Tesla deserves. But then secondly, it just forces a ton of buyers to buy the stock, whether they like it or not, because of the way indexes work. And, you know, ironically, at the highest price Tesla's been. So it's kind of a nice thing because, you know, as a Tesla shareholder, I think that will really help, you know, broaden the base of shareholders, create more stability as well, and of course be a constant flow of new funds into Tesla stock as people invest in the index.
So you've done the .com, you know, the boom and bust. What is actually different this time to you?
You know what's different is things were good during .com. You know, this is the craziest thing. Like during .com, earnings were going up 20% a year in the S&P, and same with the S&P. Right now, we have the worst economy I have seen in my life, and yet the market's at all-time highs, and we're seeing a bubble-like environment with lots of individual investors taking up investing all of a sudden, and a lot of with stimulus funds nonetheless. So we've entered a really interesting stage that isn't comparable in America, where we have a stock market boom while we're having an economic bust. So, you know, we just don't think that ends well. You know, you can pump markets, but in the end, you have to make stuff and have a real economy. And so, you know, we're very conservative right now. I'm not convinced this is a bull market, even though the market keeps moving higher, and we're in a very conservative position. But we've made a ton of money on our equity side because we're technology investors, and we're still very bullish on the stock market because we think there is no other game until rates go higher.
Yeah, so the thing is, right, there's two aspects. One, of course, you talk about the bifurcation or the split between the real economy and the stock markets. We've been talking about that for some time. But at the same time, right, everyone talks about there is no other alternative, you know, the TINA trade, the FOMO trade or whatever. Because of that tech composition, do you just expect to see the US continue to outperform?
No, actually, you know, I think if you look relatively, like actually China looks pretty attractive to me when you look at where they are with COVID and their economy based off where their stocks are. I think China's actually, you know, decently attractive. Now, that being said, we're not doing a lot in China at this time because we're still riding our U.S. stocks. But I think, you know, if you're a traditional valuation investor like me, and I'm not going to like change what I've been doing for 30 years just because we're in another bubble, you know, when you got a 26 PE on the S&P, you should have earnings going up 26%. But we have earnings going down 26%. So, you know, I just don't see where the stock market can go other than just throwing capital in at higher valuations. And so there is more upside potential, but in the end, the stock market and the economy will come together again, whether the economy gets substantially better, which is what we hope will help that problem, or the stock market will go down substantially, which would be another solution. So what we suspect is actually the economy is a lot stronger than what people think.